you considering buying a new home or refinancing your current mortgage? Now, when shopping for a new mortgage loan, you're going to see there are two main types. You have adjustable rate mortgages, or ARMs, and you have fixed rate mortgages. Now, both have their pros and cons, and today we're going to break them down so you can make the best decision for your situation. So, what are adjustable rate mortgages? Well, ARMs are loans where the interest rate can change over time. ARM loans can be a little tricky to understand, so let me expound on this. You see, ARM loans start with an initial fixed rate period, typically lasts between 3, 5, 7, or 10 years. Now, during that time frame, your rate doesn't change. For example, in a 5-1 ARM, the rate is fixed for 5 years and then adjusts every year thereafter. Now, after the initial period, your rate will adjust based upon the federal benchmark rate, plus a margin that the lender will set. So when it's time to adjust the rate, the lender will check the benchmark rate and add the margin to determine the new rate. So, for example, if the benchmark rate is 4.5% and your lender's margin is 2%, well, your new rate is going to be 6.5%. Now, just because your rate may fluctuate doesn't mean there aren't limits on how much your rate can change. These limits are called caps, and there are 3 adjustment caps total. You have the initial, which limits how much the rate can change at the first adjustment. Then you have periodic, which applies to the later adjustments. And then last but not least, you have lifetime, which sets the maximum limits of rate changes over the life of the loan. So what makes ARMs appealing? Well, adjustment rate mortgage loans usually have lower interest rates than fixed rate loans, which means lower initial monthly payments. Now, this is really great if you plan to move again in a few years or expect the rates to drop in the future. However, if rates go up, so can your payments, making budgeting a bit of a moving target. All right, let's get to the pros and cons of adjustable rate mortgage loans. Now, the pros include initial rates being lower than fixed rate loans, meaning lower payments at first. Also, if the benchmark rates do decline, you could save money over the life of the loan. Finally, if you plan to sell your home in a few years, you may be able to pay off your adjustment rate mortgage before the first rate change. Now, there are cons to ARM loans. First, payments can fluctuate greatly over the life of the loan as the benchmark rates do change. Second, ARM loans can be complicated and hard for new borrowers to understand. And finally, well, you may need a larger down payment for adjustment rate mortgage, meaning more out-of-pocket costs at closing. All right, now let's shift lanes and talk about fixed rate mortgages. In recent years, nearly 90% of home purchase loans were 30-year fixed rates. Why is that? Well, these are the set it and forget it option of home loans. The interest rate is locked in when you close the loan and stays the same for the life of the loan, which could be 10, 15, 20, or even 30 years. Now, this stability means your monthly payment for principal and interest stays consistent, making it easier for you to budget. But do keep this in mind. If the lender escrows property taxes and insurance, your total payment could fluctuate as these costs change. Now, fixed rate loans are perfect for first-time buyers or, well, really anybody planning to stay in their home for a long time. And they're simple, they're predictable, and they protect you from rising interest rates. Now, let's talk about the pros and cons of fixed rate mortgages. Now, the pros include consistent payments throughout the life of the loan, as your interest rate is locked in from day number 1. Now, the only time that your payment will change will be due to the increases or decreases in escrow payments. Now, second, fixed rate loans are easier to understand than ARM loans. And finally, well, you can forget the benchmark rates after signing your fixed rate mortgages. It really is, as I said earlier, a set it and forget it. Now, there are drawbacks, however, because fixed rate loans tend to have a higher rate than ARM loans initially. Your monthly payment will be higher. Now, this leads to another potential problem or a drawback. That higher monthly payment may make it harder for you to qualify if your debt to income ratio is close to the lender's limit. Now, finally, taking advantage of lower rates in the future may be much more costly if the rates decrease, as it may require refinance with a full set of closing costs. How do you choose? Well, an ARM loan might be right for you if you want a lower payment initially, expect rates to decline, or plan to move within a few years. Now, meanwhile, a fixed rate mortgage makes sense if you're planning to buy your forever home. You're a first-time home buyer looking for a simple mortgage, or you want to lock in a low rate to protect yourself from rate increases in the future. At the end of the day, consider both options and choose the one that makes the most sense for your financial situation. And friends, that is it for this adjustable rate versus fixed rate mortgage video. I wanted to make a small, bite-sized, easy to digest video for you. Now, if you have additional questions on this topic, by all means, leave a comment down below. If you want to see more videos like this, be sure to hit the subscribe button. And last but not least, before I go shutting up the cameras, look, as a proud veteran who has called Orange County home for nearly 30 years, I bring dedication, discipline, and deep local knowledge needed to help you navigate this ever-changing real estate market. So whether you're searching for your dream home or planning to sell, I'm here to guide you every step of the way. Now, as a realtor, I'm committed to ensuring that you get the best results. So feel free to reach out anytime, 949-726-2601. I'm happy to help, and friends, I will see you in the next video.